Welcome everyone. In this video, I'll show you a statistical and engineering approach applied to automated trading. I'm Andrea, your automated trader. And if you like what I do and my videos, leave a like and subscribe to the channel so you don't miss any content. What an audience. In this video, as I was saying, we're going to look at how to manage a portfolio of multiple expert advisors working on the same account. In my case, I have 26 different experts all working simultaneously. So one thing I've set out to do is to calculate what a potential negative day could look like and how much my expert advisors could lose. Of course, this can't be predicted perfectly, but you can estimate it by taking a statistical approach and calculating what has happened in the past and in recent periods. For simplicity, I ran all the tests of my experts over the last 4 years, where the last 10 months are out of sample, so they weren't optimized, but rather show how the experts actually performed. Based on the optimizations of the periods we previously selected, on which we operated, developed the strategy and optimized the strategy. For simplicity, I went ahead and created a table for myself, an Excel sheet, which we will now look at in detail. In the first column, we have all our experts, the ones that are working on my account. Here, I have named them in various ways to identify them. In the second column, I put the symbol to understand which symbol each expert is working on. So as we can see, I work on a total of 8 different symbols. The next column is the start date of the test. And then there's the end date. These two parameters are needed to calculate the actual number of trading days we have in this period. For simplicity, I went ahead and calculated them. By dividing the days in the interval by 7, I calculated the number of weeks and then multiplied by 5 trading days per week. This is an approximation because there are days when the market might be closed, not operating, but it's a first approximation. It's not something that's going to change our lives. We then added a column where, for each expert during this test period, we recorded how many trades were made. This is an important piece of data because we use it to calculate how many trades per day that expert makes. So, for example, in the case of the first one, we have 1,044 trading days and 684 trades were made. So we're going to do 684, as shown in the formula, divided by the numbers. And we get a number that tells us that statistically and on average, our expert makes 0.655 trades per day. The last column we have, before calculating the risk for each expert, is the one with the risk per trade. So in this case, we have 1%. These values are important because they allow us to calculate an average daily risk for this expert. How? Let's take a look. We took the average number of trades per day and multiplied it by the percentage I risk losing if the trade hits the stop loss. So in this case, we have this number, 0.00655. Since I have multiple experts, in my case I have 26, I do these calculations for all the experts. In the end, I will get this column with all the daily risk data for each expert. The first approximation I can make is to sum up all these numbers, and in the end I get this percentage, which is a total of 16.74%. What does this mean? It means that if we had a correlation equal to 1, so if all the experts worked together on average and were correlated, we would have this value of 16.74. In reality, it would be more accurate to take this column and transform it as if it were a vector multiplied by the correlation matrix of all the experts. So we have the transposed vector multiplied by the matrix and then by the vector again. This would give us a number much lower than 1674 because under normal conditions, the correlations among the various experts I use are very low because, let's say, they do quite different things from each other. So they are strategies, maybe even on the same symbol, but they do different things, so they're not very correlated, neither in losses nor in profits. This wouldn't be very meaningful because what we want to do is try to estimate a very negative situation. In other words, we want to know the worst case scenario that could happen to us, or at least get an idea of what the worst case might be. So to address this, I used a corrective factor of 0.8 and multiplied the total risk by 0.8. And this will give me a plausible estimate of what could be an excessively negative day for my systems. In this case, I find that in one day I could lose 13%. Is that a lot? Is it a little? Is it sustainable? I don't know. It also depends a bit on your own risk tolerance. In my opinion, for what I do, it's a sustainable value. 13%, also because I always calculate the stop losses. So what I lose is based on my balance. This means that if one day I lose 13%, the next day I'll be working with even smaller sizes because my balance has gone down. If I keep losing, the sizes will keep getting smaller and smaller. And this gives me a bit of a parachute effect. Of course, in the end, I could still lose the whole account, but it really slows down the losses. This way, the system can keep going over time, and I have the chance to turn things around and recover what I've lost. If we want to be even more pessimistic, we can consider, instead of this 13%, the incorrect value. So let's take this 16.70, let's say 17%, which could happen on a catastrophic day. Clearly, this isn't the kind of day that happens every week. It's the kind of day that might happen once a year because of some unpredictable event. For example, a day when some special announcements are made. A day when a war breaks out. These are things that are unpredictable, but they could still happen. In any case, we protect ourselves because we know that the maximum we could lose is 17%. So in any case, it doesn't kill the system. A day like that, or even two in a row, we might lose about 30% with this parachute effect we have. It's a lot, yes, but it's not catastrophic. It hasn't killed the system. The next step I took was to gather the various reports, let's say, from the experts for the period we have from the beginning. So from October 26, 2021 to October 26, 2025, and to combine them using Quant Analyzer. We need to keep in mind that in this period, the last 10 months are all out of sample. What does that mean? They are all real data. They haven't been optimized because the optimization ended at the beginning of the year. So from 2025 up to today, all of 2025, it's an example of how our expert has performed in real conditions. It's not a test, it's an example of what it has actually done. And this is a very important piece of information to check if the system is robust. So let's go and see in Quant Analyzer what came out of this data. To avoid boring you, I've already loaded all the reports for the various experts, but it's actually very simple to do. You just click Load Report, then choose the one you want, open it, it needs to be in HTML, and click Continue. This way, all your back tests and expert tests will be loaded into the list. I've already done this. I just put this letter in front to have them in the order I wanted. So here I have all my strategies and how they performed. There are some that earned more, some that earned less. There are some, like this one, that earned very little. However, since I work with very long periods, it could be that in 10 months they haven't made much, but maybe they'll earn more later on, or we'll see. In any case, statistics show that over many years the systems are profitable, so a period of stagnation is normal. It's not a big deal, even if it's at a loss. I would still use the expert because 10 months of losses out of, say, 10 or 15 years of testing I've done are not significant. Because it can happen that for 10 months it doesn't make a profit, and then the market picks up again just like before. Once all the strategies are loaded, I select them all and create a portfolio. At this point, I've already done this. I go to the portfolio and I have my portfolio that has been created. What can we see about the portfolio? All right. In the meantime, we have an overview with everything that has happened, with how the months have gone. We can even see that the entire portfolio had some months where it went negative, but overall it is more than profitable, so this shouldn't be a problem for us. We have the list of all the trades. If we want to look at them, they're in chronological order. Then we have the equities. At this point, we can see all the equities of our strategies. If we want, we can also add the portfolio here. So, as we can see, clearly you can't see them all anymore because the portfolio is very large, but we can see the overall equity of our portfolio. What is interesting to see in this equity? First of all, it's an equity curve that is very linear and rising. Next, what's interesting to look at is the period, as we said, from January 1st onwards, because that's a period when the experts were not optimized. So if we look at this period that starts roughly here, we see that our equity went up, had a period of stagnation, went up again, moved sideways for a bit, went up a little more, then recently went up, and then it flattened out a bit. And now again, it's a period where it's not performing much. In general, though, our portfolio has increased over the year. The positive thing is that it shows we've actually done something, a mathematical model, or in any case, some strategies that has led to this model being fairly stable, because we can see that the trend we had during the optimization period is similar to what we had before. From January onward, maybe from January on, we had a few more periods of stagnation, but the trend is pretty much similar or the same as what we had during the test. Even here during the test, we had a slowdown period, so this is similar. This means that we have a robustness in the system that allows us to say that what is happening these days in these months of out-of-sample testing reflects what was in the historical data. So here we can go ahead and calculate all the correlations just like this. You click calculate and it calculates all the correlations. And here it gives us the matrix I was talking about earlier. In theory, one could take this matrix, multiply it by that vector we calculated in Excel, and then the transposed vector by the matrix. Then take the square root of the vector and you get the number that should give you the percentage you risk losing each day. This way, you are being very conservative because these are normal correlations in normal regimes. A very negative day. When there is this kind of news, these maybe exceptional events, things are completely different because we might end up hitting stop losses on everything. And at that point, the correlation between one cross and another no longer matters because everything is driven by the news. That's exactly why I say let's take a factor of 0.8 and reduce that initial value so as to have a pessimistic estimate. In the overview, we can see an important figure, which is the drawdown. Here it tells us that we had a maximum drawdown of 15.70%. Empirically, compared to what it gives me, the Quant Analyzer, I always take a drawdown value that's double to get an idea of what the real drawdown of my system could be. So I set myself at around 32% to be pessimistic. Maybe it won't actually reach that, but I can say that in the worst case scenario, I could have a 30% drawdown. Yes, I know that if I get to that figure, it still won't shock me that much. I'm calm because it's part of my statistics that I made. A next step, let's say, that I wanted to take to analyze the validity of my mathematical model was to do the analysis, Monte Carlo. Monte Carlo analysis is basically an analysis where you reshuffle the order of trades. So, if one had taken a positive series of trades, fortunately with Monte Carlo analysis it comes out and therefore understands that the system is not robust enough. In our case, we did it with 1,000 steps. The value that is usually used is the 95% Monte Carlo one. So in this case, we see that our drawdown, which was originally 1,573, in this analysis has become 1,739. Still, a perfectly reasonable drawdown. And the increase we've had is a very small one, which again indicates a system that is statistically and mathematically robust. What else can we analyze? Let's take the value of 100%, which is the worst value it can give us, the analysis, Monte Carlo. And what do we see here? Let's see, in fact, that we have that drawdown that I have empirically estimated at 32%, therefore double the initial one. This means that we are still within a model that, even according to the Monte Carlo analysis, confirms that we could have this in the worst case scenario. A 32% drawdown, which is still a manageable drawdown, especially considering the performance the system has had, because in recent months it has achieved a 30 to 40% profit per month. So, losing 30% in drawdown during an extremely negative period is, all things considered, reasonable. Then, if someone doesn't have this risk tolerance, they can always reduce the risks of all the strategies, and they will have smaller drawdowns and smaller gains. Here we can see, in fact, the chart from our analysis, Monte Carlo. As we can see, we have a range, let's say, within which all our strategies move. The last thing we can look at is the forecast that this program provides us to try to get an idea of what might happen in the future. So let's see. The forecast check that this program can provide is a piece of data that can be useful to understand how things might go, what the range will be in which we will move in the future. As we can clearly see here, we might find ourselves facing a situation that is not entirely ideal, the so-called worst-case scenario, which has been carefully calculated, which still leads us to make a profit in the future, though the profit is much less than, let's say, the upper line, which represents the optimal or best possible condition. As an engineer, I would suggest aiming for the central part of this range, as it offers a balanced and more reliable outcome. And so the system seems to reflect what has happened in the past. So, to sum it all up, what have we achieved? From all this mathematical analysis, we've determined that we have a maximum risk of a catastrophic day of 16%. We have a drawdown provided by Quant Analyzer of about 15.7%, which I personally interpret as double, so a maximum drawdown of 32% that I might see over the years using my system. The Monte Carlo analysis at 95% gave us a drawdown of 17.4%, while at 100%, which is the worst case scenario, it tells us exactly that, 32% drawdown. The monthly return in recent months has been over 30%. We have had system stability in the out-of-sample period of 10 months, which indicates that it performed identically to the optimized period. And then we have one last value that I calculated, which is a time window used to collapse the system. That is assuming thanks, with average risks of all the trades that the system makes. So I took about a 1% risk, having 5 losing trades and 1 winning trade that's double the size of a losing one. By working this way, the system continues until it reaches zero in order to collapse it. It would take more than 10 consecutive weeks of working this way, which is a period of over 2.5 months, during which it would basically always be hitting stop losses and very few profits. Still, even like this, we can hold out for over 2.5 months. 2.5 months. If we crash, it means the market has fundamentally changed. Completely. It's no longer a matter of us not having created a correct mathematical model, but rather that the market has completely changed. And you can't even think about re-optimizing the system because that would mean it's just not following the rules or what it used to be in the past anymore. So I can't go and optimize something based on 2.5 months that are different. Because 10 years ago or 20 years ago or 15 years ago when I was working, things were completely different. The market has changed, a catastrophe has happened, and our system no longer works. So this is not something that can be predicted. So in engineering terms, the model is stable, consistent, and statistically well-conditioned. The residual variance is minimal and still falls within the normal range for multi-strategy systems. In conclusion, we can say that the system's limitation is not the code or the mathematical model it uses, but rather the change in the world itself. So a radical change in all markets could bring it down. However, this is very unlikely for our system. These results, as I mentioned, refer to a period that has now passed, and the past gives us no guarantee about how the future will go. It can only help us to better interpret the market, but without any guarantees, because everything could change and we could end up losing the entire account. So these are not financial advice, but are only mathematical and engineering calculations applied to automated trading. Let me know in the comments if you like this video and if you think the approach I use is correct, or if you have any suggestions for me, or if you want me to do other calculations, other statistical analyses on the various experts I am using. If you enjoyed this video, don't forget to leave a like, subscribe to the channel, and stay tuned to see the next videos I'll be posting.